Hi, I'm Alex Davies, founder of Wealth Club. Today I'm with John Davies, Investment Director at Seneca Partners, to talk about the Seneca Growth Capital VCT. Hello, John.
Good morning.
First, can you tell me a little bit about Seneca and some background about yourself?
Of course, yeah. I'm Investment Director at Seneca, heading up the EIS and VCT funds that sit in our growth capital investment team. In terms of Seneca more broadly, Seneca's been around for around about 7 years. In that time, it's grown from 3 guys in an office based in the northwest to having almost 750 million under management, and that is spread across multiple disciplines, which include private equity investing, bridging, asset-backed lending, advisory, private equity investment, fund management, and of course VCT and EIS investing.
So tell me about the VCT.
The VCT. So we launched the VCT last year, and it's been a great first year for us. We've raised 5.5 million from a standing start. We've invested in 5 exciting growth capital businesses. We've already paid our first maiden dividend as well.
Okay. And what sort of companies are you looking for?
Well, in this segment, it's all about trying to de-risk the proposition. So we aim to invest into more established businesses. We definitely don't do startups. With those businesses, we have a generalist approach, again, which helps with diversification. We're looking to back management teams, essentially, with good growth potential. As well as the diversification through our generalist approach, we like to back AIM-listed and private limited companies, around about 50-50 in terms of the portfolio spread, which also gives us a certain level of liquidity within the portfolio. A lot of our deal flow comes from the region, so we've got a regional focus, which we think gives us better value in the investments that we're making because there's less competition.
You talk about competition, but is there much competition for the deals in general?
There is, certainly for the deals coming out of the city, and we will invest in the deals coming out of the city. But what we found, particularly with the first 5 investments we've done in the VCT, the majority of those have been off-market deals.
Okay. Do you want to talk to me about some of the deals you've made this year?
Yeah, absolutely. We've got a really exciting portfolio already. We've already managed to get a blend of AIM-listed and private limited companies, and it's a diverse spread of sectors. One in particular, which is a really good example, is Cyclr, which is an online marketplace for new and upcoming female fashion brands. They provide businesses with a platform to help facilitate sales, marketing, and customer service. And Cyclr, even before we'd invested, had already showed a great track record of growth. They grew from around about 11 million turnover in 2016 to 39 million of turnover for the calendar year 2018, and reported a record quarter in the first quarter of this year as well. Again, more established business. We were looking to go in at rounds 3, 4 rather than 1 and 2, and an exceptional management team.
So tell us about the others.
Okay, so there are 4 other businesses we've invested in. One of them is an AIM-listed business called Skin Biotherapeutics. It was actually a spin-out from an earlier EIS investment that we'd made into Optibiotics. Again, a very, very strong management team, great product, looking to commercialise that in the near future. The other 3 companies include Fabicus Limited. Fabicus is another tech platform, another established business that already has contracts in place with large corporates. And what Fabicus was looking to do is bring more clarity to the supply chain market. Their idea was to enter the market with a basic level customer proposition, and then land and expand. And that first one is trying to bring clarity to the relationship between licensees and licensors. Great growth potential, great business. The other 2 are Old Street Labs and Qdini. Old Street Labs is a procurement tool for corporates, which allows several parties across the globe to collaborate on different procurements within those corporates. They'd already had contracts in place with the likes of Vodafone, to name one. Qdini is another software platform, but it's got a retail focus. So what Qdini does, it provides a platform for retailers to enable them to reduce queue time and increase customer service propositions within their estate. They'd already signed contracts with the likes of, I think it was John Lewis and a number of banks, which not only helps them with the customer service and stops people having to queue when they don't have to, but it also gives them an enormous amount of data. So they can start to refine their propositions, so they know, who's coming in, when they're going to be coming in, where they go in the store, etc.
And are you restricted by the money you've got, because you say you've just had over 5 million in the VCT?
Yeah, it's a good point actually. And this time last year we mentioned this was one of the key USPs or differentiators of Seneca, was that we can invest alongside our EIS funds. In these 5 in particular, this has enabled us to do larger check sizes than would otherwise been. We wouldn't have been able to do that with the VCT alone, so we've been able to invest 2.5 million in each of the deals, which gives us better equity stakes and better protections for our investors.
Obviously it's very early, but have you had any exits yet?
We have, yeah. Well, I mean, we already had quite a good track record in terms of growth capital exits through our EIS funds. We've had 9 exits, averaging around about 2.6 times return. But in the 5, even though it is early stages, we saw the share price of Skin Biotherapeutics go up. Skin Biotherapeutics go up quite significantly shortly after we invested, so we sold down some of that holding for 1.5 times return.
Okay. It's a risky area that you're in.
Absolutely.
All EIS VCTs are. Of a portfolio, are you expecting some of these companies to fail?
Yeah, I mean, look, there's no getting away from its high risk area of the market, which is why it's always about de-risking as best you can through diversification, through expertise, through good investing at the right values. Of the 80 rounds of investment and over 44 companies that we've invested growth capital in, we've only ever had 3 that have failed. And we'd hope that would be the kind of ratio that would continue.
And if I was going to invest in a VCT this year, why should I choose you?
Yeah, okay, good question. Again, like I've just mentioned, in this game it's all about de-risking. With Seneca, you have an award-winning growth capital investor, and we've tried to de-risk our proposition, mainly through diversification, so generalist approach. Regional focus where there's less competition, and a split of AIM listed and private limited companies. We can also pay dividends, and we have already paid our first interim dividend, and we have deal flow in excess of looking at 500 deals a year. We also bring to the table a better or a larger and wider skill set than most VCTs because of the multidiscipline approach that Seneca has. Across all the different faculties under the Seneca Group umbrella.
John Davies of Seneca, thank you very much.
Cheers.